Hello and welcome to a brand new episode of Mind Over Money, a show where we talk about ways of how meditation, yoga, and behavioral science can help you become a better investor, trader, or a better human being. Well, my name is Satish and today we have with us a very special guest, Rahul Jain, who is President and Head Personal Wealth at Edelweiss Wealth Management. Well, this is the part two of our series on behavioral science with Rahul. Well, in the first part, we talked about important elements of behavioral science, confirmation bias, as well as loss aversion. Well, without further delay, let me invite Rahul to the show. Welcome to the show, Rahul.
Hi, Kshitij. How are you? Thanks for inviting me to the show.
The first part was very interesting. Now, if we drill down behavioral biases further, we've seen many channels on social media, be it Telegram or Facebook, where the so-called unbiased tips are there. Now, SEBI has definitely come down very hard on such groups, but why do investors instantly believe something on hearsay?
I would say, rather looking at the efficacy of Telegram channels in terms of whether bias or not, we should be more careful in understanding that who are running these channels or providing the content on the same. Because if they are well-registered research advisors, credible companies doing, then it can be helpful for people because they might want to use that content for their trading, investments, etc. So it cannot be said that might not be, it will be very helpful. But also people should be careful because there is a lot of fake info, misguided, etc. can also happen. So knowing the credentials of the content writers on those channels would be very, very important, critical, which our subscriber investors should look out for effectively. Because what I have seen also is that there are a lot of channels, etc., which only shows you the better part of the positive part of trading. And actually that is something which makes you feel very excited. Might not be very fair, but I think individual should have a clear understanding that once he's getting into these ideas, suggestions, etc., what all can happen. So I think looking at the credentials is important. I think from the new investor point of view, correct, getting into these sort of channels, hearing them out or also following them is the way human behavior is not different. 10 years back, people always used to hear from their friends, family, relatives, known people that what to buy, what not to buy. Since the whole society is evolving, where influencers on social media channels are becoming more and more important in guiding them out what not to do. I think the same way these channels also getting evolved, and the behavior is very similar. Also, sometimes I feel that there's a herd mentality also which keeps happening because if you want to invest in equity, correct, in any equity stock, it requires a lot of work, understanding about a stock, fundamentals, whether the company is good or not bad, how much amount of investment you want to do, but you have to do all those basic understanding. I think following these is an easy path, might not be very good, but also it helps you to have a confirmation bias because if a lot of people are following, you will believe that it tends to be good or okay. Right. And I think there are these sort of things which makes people instantly believe or hearsay. But I think I want to again say that you should look at the credentials of people who are giving that content. That will be very important.
Important note there from Rahul. And how can one overcome these biases and become more effective when it comes to investing and trading?
I think one of the things which I personally feel, whether you're investing or trading, being disciplined is one of the most important traits. Right. So if you look at trading is about doing your trades day in, day out, correct? It's a short-term thinking. You might be doing trading for the day, for a 2-day, 3-day horizon. I think being disciplined is important because putting stop losses is a very critical part in becoming successful in trading. Because you're okay with lots of loss-making trades, but your profitable trade should be big. And that is the whole mantra of becoming successful in trading. So being disciplined is important. If you're a long-term investor, also discipline is important because your biases creep in at various points of time. And being disciplined will allow you to not get that biases creep you too much. That is one. I think you have to be logical in your thinking. If you're logical, the chances of biases creeping in might be significantly reduced. That is the second one which people should keep in mind. Third is that you should always understand your financial position or your risk appetite. Because what happens, what I've seen a lot of times is that if you've done something which is far bigger than what you can actually absorb in terms of losses, etc., you tend to take always wrong decisions, whether it is market going down or market going up. And having a great understanding of the same is very important. Also, how your risk behavior is that if markets are falling and if you're getting losses in your portfolio, are you comfortable because you can think that, boss, this is long term, I don't need to get worried right now, but you start panicking. If you start panicking, then you have to be adjusted in your thinking. So knowing about your financial position risk has to be important. And last is that always have a friend, coach, advisor who can help you out, because doing conversations helps you relieve doubts. There can be a counterpoint of view which can help you have a more thought through the points in your mind, whether you want to enter or exit and how you want to look at your portfolio. I think if you're able to take these three, four into consideration, like being disciplined, be logical in thinking, understand your financial position or risk appetite, and also have someone who can chat and talk about. I think if you're able to take these three, four into consideration, you're in a good space.
Right. And lastly, how does behavioral finance differ for traders and for long-term investors?
It is different. It is different because I would say skills required are little different because trading in markets is a daily affair. You have to have a very good view on short term, understanding psychology of markets, very, very disciplined. Discipline is the most critical in the trading part. But if you look at investing, I think it is more about long term thinking, looking at the fundamentals, understanding the nuances more about a company, etc. So in that sense, I would say that trading is like psychology of markets, where you read people and you depict or trend that what will happen in next 1-2 days, 2-3 days. On the long term investing would be like understanding the philosophy of businesses where you've invested. And that is how you should differentiate. And I think in that sense, skills are differently required. That's why what I've seen, people who are successful in trading generally tend to not invest, and people who are successful in investing tend to not trade. That is what I've seen in a lot of successful people.
Right. Well, on that note, thank you, Rahul, for your time today. And that's all for now. But do stay logged on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time, sir.